Hi guys, and welcome to the first episode. In the first episode, I would like to introduce quite quick the value investing and how we can invest in an efficient market. So, first thing, a professional disclaimer. The YouTube channel and presentation does not contain any financial advice. And especially all the information that I will provide are just general information for educational and entertainment purpose. And they do not substitute any professional advice. And then especially we do not provide any kind of financial advice. And if you want to use the information inside of this presentation and the YouTube channel, it's solely at your own risk. So, let's start a bit with a timeline. In the timeline, we will define first our investment goal. And basically, the first basic investment goal is to not lose money. And then we will try to see how we can have a good profit without an high risk. Second thing, I will introduce a bit the value investing in a quick way, and basically how can we invest based on the fundamental analysis. Then an important concept about the durability. So consistency implies a durable competitive advantage. So we will see a bit what is and why it's really important, the competitive advantage, and especially a durable competitive advantage. And to find it, we have to mine the financial statement. From the financial statement, we can derive a key ratio that are really important to analyze and compare businesses in the same industry. So, let's start a bit with a personal experience. So, the first personal experience was not really great, and especially I set up a poor portfolio. What does it mean? Well, I didn't have, let's say, a financial education. So I start to rely more on the information found on some magazine. So I have also paid abonnement to some magazine, to some blogs and so on in order to document myself and to read a bit and understand how I can invest in order to, let's say, avoid to lose money, leaving money on the bank account. Because of inflation, because of many other reasons. And at a certain point, I start to buy stocks without doing any financial analysis. And the portfolio starts to perform a bit well, but then after a while, because of rising of the inflation, the portfolio starts to perform quite poorly. And I understood that I need a financial education in order to change and to define my strategy, my investment strategy, if I want to do stock picking. Otherwise, it's better to do, let's say, less research. Of course, you have always to understand, to document to search for information. But then it's better to buy ETF, maybe ETF that maps some indexes, rather than doing the stock picking. And I understood that basically I start to lose money because some stocks went down and went down a lot. And there was no recovery on the long run. And basically I had not only, let's say, losers, but also gainers. And the issue is that losers eat the gainers' profit. So I've lost time, I have lost money, and not a big amount of money. Then mainly, the gainers has compensated more or less the losers, and basically the portfolio has been heavily and negatively impacted. So at a certain point I said, okay, but how great investors do? I mean, there should be a technique, or there should be a strategy, let's say in general. So I tried to read some books, and I'm still reading some of them, some other books and so on about investors, about value investing, about how to read basically financial statements. And I've noticed that many of them follow the value investing strategy. And basically they try to find the superstar companies and they just wait. On the long run, the superstar company will perform quite well. So, of course, this strategy, so the value investing, requires the time to analyze stocks, to analyze basically the financial statements, to analyze the different key ratio, to compare key ratios between, among companies in the same industry. And of course, you need experience. You need to study and you need a lot of patience. So I'm a value investor beginner. I have a certain passion around this, so I start to read, I start to, let's say, to understand a bit how can I do to evaluate and also to create my own jargon. So, my vocabulary, because I come from a totally different field. And so I want to share my journey that I am doing in the value investing. Currently, my portfolio, recovered, so I'm quite in positive. But then I mix a stock picking with ETF. Because I want to try to define, to create an all-weather portfolio. I think ETF, they are a beautiful instrument. They are really, really great. I usually choose ETF that map a certain index, and I try to create this all-weather portfolio. But then about ETF, it's another topic that we can discuss later. So here there is a quote by Warren Buffett saying that you have to understand accounting and you have to understand the nuances of accounting. Accounting is a language, and in general, the language of the business, it's a language that is not perfect. But if you don't want to put effort to learn accounting, that means how to read and interpret financial statements, it's better that you do not select the stocks yourself. So this is, let's say, one of the most important principles when we talk about value investing. Value investing requires time. So if you have a passion, if you want to understand a bit more, if you want to just develop a bit your curiosity, I think it's a very nice journey in order to learn, in order to also be able to look around and to understand what you read every day in the different newspapers. So instead of just investing, let's say, blind, as I did at the beginning. So let's try to define the investment goals. First thing, I don't want to lose money. This is the most important thing. The first rule of an investment strategy is to not lose money. It can be silly, or it can be something that no one talks about. But my honest opinion, the first rule should be, let's try to not lose money. If you have some losers and some gainers, and the lose and the gain compensate, so what you have in your broker account, so the gain and loss, it's equal to zero, or I don't know, plus 0.1%. Okay, that is already a good point. It's a good starting point. Another goal is that I'm looking for stability. I want to sleep well during the night. I don't want to invest in some stocks or even ETF, because there are also ETF that are not really great ETF. And I don't want to think that I'm losing money and I cannot recover in the future. I already done this and I don't want to do it anymore. So stability could give a good chance to predict future performance. Just a chance to predict could give a good chance. We are not sure. And what I want to do, I want to minimize the risk. So if I analyze a stock based on the latest 10 years, and in the latest 10 years the stock had a certain behavior, a certain performance and so on, I mean, I could think that in the future the stock could have a similar performance. So minimizing the risk is the key to sleep well. And another point, another goal of my portfolio is that I want to have growth. So I want to buy stocks of superstar business, and I want also to exploit the compound interest. The compound interest is something really fantastic, really great, that helps a lot to grow your portfolio. So the ideal thing is to have both growth, but then also compound interest to basically maximize the growth of my portfolio. And then once I have defined more or less this kind of principle, I don't want to do nothing. I just want to wait. I don't want to sell and buy and sell every 2-3 days. So I just want to buy a certain stock or a certain ETF if you want. But then I know that when we talk about stock, we talk about a superstar business. I want to do nothing. I just want to wait that the market correctly values the company stocks that I have in my portfolio. Now, what is in general value investing? Well, it's an investment strategy. Basically involve picking stocks, as I've told you, and the stocks that are underestimated by the market. Basically, stock value is less than its intrinsic or book value. And we consider that the market is inefficient, means that the market does not price in the right way a stock at certain point in time. So the stock is undervalued. What does it mean and why it's undervalued? Because investors are panicking. When people are in a panic mode, they start to sell. When they are in an exciting mode, they start to buy. They don't care about the price. There is the famous FOMO, fear of missing out. All the people buy and then there are other people buying more. This is what Benjamin Graham called Mr. Market. Mr. Market is the investor that basically goes rapidly from fear to be excited. Then other reasons are the economy that can perform poorly. We can have inflation issue, or we can have just unexpected earnings, and so a stock can lose a lot of value just because the earnings have not expected in that way, or just because the guidance is not what the market expects, or the analyst or investor expect. And then finally we can also have the media that they don't cover enough certain stocks, so there is a lot of hype around certain stocks, so they are a bit hidden, not really well considered by many investors. And this is really the point where we have to look at. So we have to identify those stocks, and then we have to analyze those stocks, and maybe those stocks are really the best in the class, or they are not maybe the best, but they are really good stock because of the financial statement they have presented every quarter or every year. And when we have identified them, we have to consider what is the target price or the intrinsic value, and especially consider the current price. And then see if we have a 20-30% of margin. Maybe we can buy them for less at a bargain price. So we always try to keep a margin of safety, because when I want to buy a stock, I want to keep a margin, because I don't know how the market can react in the next month. So I prefer to keep a margin, and I want to buy that stock, keep the stock for a long time, and resist the temptation to panic when price drops. In one of the interviews, Warren Buffett said, when all the people panic because the market crashes, we are happy because we know that we can buy more stocks at a very low price. And then they just wait until the stock reaches the intrinsic value, or maybe even a higher value with respect to the intrinsic value. Sorry. And then Benjamin Graham in 1949 wrote a book. Benjamin Graham was a Columbia Business School professor. He wrote the book The Intelligent Investor, that probably you have already heard about it, where he explained the value investing concept he has developed. So, what is the core of the value investing? First thing, as we said, the market inefficiency. The stock market is inefficient and underestimates certain stocks. And basically, undervalued business could constitute really a very good opportunity. Then we need to have a diversified portfolio. So we need to have a diversified portfolio of undervalued stocks. So basically consider different sectors and industries, but pay attention, this is not enough. Why? Because it's not enough to buy undervalued stocks. This was one of the techniques of Benjamin Graham, saying, I want to buy undervalued stocks because they can recover in the future and they can give me a profit. But then Warren Buffett noticed that basically there was something not totally correct, because some of those stocks could basically not recover, or maybe some companies can also go into bankruptcy. So the losers reduce the performance of the winners. And this is exactly what happened to me, to my, let's say, poor first portfolio. So the strategy, the innovative strategy, is to find a superstar company, superstar business. And basically exceptional businesses that are undervalued or oversold with respect to always their intrinsic value. So superstar company is a business with a durable competitive advantage. Pay attention, it's not only competitive advantage, but it's durable. And basically in this way I can reduce the risk and then I can increase the gain on the long run. So of course the first rule in an investment is to not lose money. But then of course all the people want to maximize the gain. So I want to find company that are the best investment and can make the most money during a long period of time. And I don't need to maximize the risk to maximize the gain. I need to spend the time, and unfortunately you have to spend a lot of time, but then you need also to have experience, you need to study, you need to really understand how to read the financial statement to find those companies. Now, we have talked about the durable competitive advantage. So not only competitive advantage, but durable. So first thing, what is a competitive advantage? The competitive advantage usually creates a monopoly-like economics, where a company can sell more products or charge more with respect to its competitors. So those companies have an advantage over the competitors. Let's think about For instance, Coca-Cola. Coca-Cola has a durable competitive advantage because comparing to other competitors, they can also decide to increase the prices, and basically they can increase also the profit because people will keep buying Coca-Cola. Then another interesting point is the durability. If the competitive advantage is durable, the value of the business would increase year over year. Because if you have a competitive advantage only for a small amount of time, because another competitor managed to sell a product more or less like yours, but is slightly better, but you can lose the competitive advantage. But if you can demonstrate on the financial statements the durability, means that the value of the business would increase year over year and reduce to zero the chance to go into bankruptcy. So for this reason, we are looking for durability. So basically in the financial statement, consistency, the company increase, for instance, the sales, reduce the debt, increase the earnings, and so on. Then another advantage of the durable competitive advantage is with respect to the speculators. Speculators could drive the stock price of an exceptional company low, but the risk that the company lose money is small. Lower the price goes, greater upside potential exists. And then pay attention to time and durable competitive advantage. It's they work in the investor favor because you have a company that has a durable competitive advantage that can increase year over year basically the business, and so basically on a long run you can you can basically increase your profit. Now we talk about a monopoly-like economics, but what does it mean? For instance, a company that sells a unique product. So, in some way, they own a piece of consumer's mind. For instance, in my case, I'm not a big fan of the different sodas. I just drink a soda probably 5 times a year. But then every time that I think about a soda, I think about Coca-Cola. So probably it's because of all the American movies and and the different let's say series that I watch in my life. But basically it's like the company owns a piece of my mind. So basically for me it's normal to think about Coke. And in general are kind of products and services that consistently people need and basically they are willing to pay for. So even if Coca-Cola increased the price of, 5 cents per can, people that get used to buy Coca-Cola, they will keep buying it. So, and especially there is another very important point. When you sell this kind of product, you don't need to change the product or the services, or maybe you don't need to change very often. And you have to do less research and development, or no research and development. You need to spend less in order to adapt the production plant. You need to spend less in for instance, marketing, because the product is always the same. And then you can charge higher prices and sell more. Then another kind of monopoly-like economics are basically low-cost buyer and seller. So basically, they can reduce the margins in favor of increasing the volume of a product or a service people have an ongoing need for. And pay attention, it's not one or the other one. Being both a low-cost buyer and the low-cost seller is the key to have higher margin than competitors. An example is Costco. Costco is a fantastic business. So they can have fantastic prices, they can buy at very low price, you can have a very good quality, and so you can have a really very good margins. Then when we talk about monopoly, means that it does not happen only 1 or 2 years. It's something that happens consistently. Basically, they have consistent financial statement. In the financial statement, you can see that basically the sales increase, you can see that the debt decrease, you can see that the earnings increase year over year. Basically, consistency in the product created the consistency in the company profits. Basically, consistency that emerges from financial statements involve the durability of the competitive advantage. Because if you see that basically a company can increase the sales, can increase the earnings, but well, it means that behind the scene they have a competitive advantage, they have a good management, and they have, of course, a very good product. Consistently having high gross margin, carrying little of no debt, growing the earnings, spend little money in research and development, these are basically the keys that we will look for. Then we have the durability, a durable competitive advantage. So it's this consistency that basically implies the durability. And if the competitive advantage is durable, the value of the business would increase year over year and reduce to zero the chance to go into bankruptcy. So the business could be in some way predictable. And as I said, I would like to underline in some way could be. So we are not totally sure. But then there is a good chance, let's say. So we can reduce the risk, we can maximize the gain on the long run. I have to do nothing, don't sell, just wait. Now, we talk about the financial statement because we have to mine the financial statements. Golden is hidden in the financial statement. We have to mine them. And basically we have to search for the golden, durable, competitive advantage businesses. And we have in general three different financial statements. We have the income statements. The income statement tell us how much money the company has earned during a given period of time. So it can be a quarter, so we talk about the 8QS, or the year, the famous 10K. And we want to look for margins, for the ROI, for consistency and direction of the earning. Then we have the balance sheet. The balance sheet tells how much money the company has and how much money it owes. So their subtraction gives basically the net worth of the company. We want to look at the amount of the cash, the amount of the long-term debt. And then finally we have the cash flow that tells us how much cash goes in and out of the business. So we want to look for the amount of the money spent in capital improvement to increase the business value. Stock, bond, sales, repurchase, and so on. So think about these kind of statements as more or less what you do with your personal finance. So in your personal finance, every month or every 2 weeks, I don't know, you consider the money that enters in your bank account, for instance, the salary, and then what are the expenses. Maybe you have some debts, you have some food that you have to buy, you have the rent that you have to pay, or the mortgage. So the financial statements basically are quite similar, if not more or less the same thing. So you can think to organize your personal finance around the financial statements. But then as it is for you, and maybe you can use some applications or something that you have already built in your bank account, but then you can use them to basically understand your personal finance. If your personal finance is good, so if you are saving money, if you earn a certain amount of money, if in the last 10 years you have increased your earnings. So if you have increased, for instance, your salary, if you have decreased your debt, and so on. This is very important. You can treat basically your personal finance as a kind of really the business of a company. So there are then other fundamental analysis tools that you have to consider. For instance, some economic indicators. You have always to consider this, that of course you don't find in the financial statements, but then you can consider the unemployment rates, the inflation, the gross domestic product growth, and so on. There are different indicators. I have just put 3 of them that you hear probably more or less every day, especially during high inflation period, and they are used by the Fed rather than the European community, the European Central Bank, and so on. And the indicators can affect the consumer habits. Unemployment rates, of course, will affect the consumer habits. So they will affect the environment that the company operates in. And so, well, the company performance. Another thing that you have to consider are the news. So in the news you can find the earning reports, the different reactions of the investors. You can find if a company has signed new contracts, geopolitical events. For instance, a war, a pandemic, and so on. They are events all around the globe that can affect basically the business health, and so the stock price. Then there are other kind of qualitative info that you should consider, like the famous mode. So the competitive advantage defined by Charlie Munger, that in this case it's more related to the brand power. So we can try to understand the durable competitive advantage from the financial statements, but then there are other kind of, let's say, indicators that are more qualitative, and basically it's difficult to find. We can in some case deduct from the financial statements, but for instance, the brand power, it's something that is more qualitative. So a brand power like Nike, like Coke, like Pepsi, and so on. This is very important for the business. Then you have also the industry cycle. Many sectors, many industries are cyclical. Then you have the management quality. Management quality, you can find from the, let's say, from the financial statement, because if something goes totally down, well, there is a problem in the management. But then also from the news, and in general, we can have some information about the management quality. And then and so on, there are other qualitative info that we can use when we do the evaluation of a company. So they are in general non-quantifiable factors that can affect basically the stock. Here, for instance, we have the word security. Security is used as a synonym of stock. This is something that I got a bit puzzled at the beginning when I started to basically to get some interest into investing, and then there were according to the channel that you listen, you have some people that talk about security, other people that talk about stocks, and so on. So in general, they are synonym. And then, of course, we have to pay attention to the interest rates, because high interest rates generally affect negatively the stock prices. Low rates instead boost the economy. Why? Well, because in general, a company, they can finance themselves using the equity, so the investor money. but also opening new debt. They ask debt via bond, they ask debt, to different banks and so on. And of course, when you ask a debt to finance your business, to finance your investment, you have to pay an interest. And if we are in a period where interest rates are quite high, you will pay much more. So here there are well-known value investors. Okay, I don't want to go through all of them because I guess that you know them quite well. And in general, they all try to find superstar companies at a bargain price and keep them for a long run. Then in general, each investor has its own strategy. So you can have a value investing strategy that is slightly different or totally different from the value investing of someone else, because someone can pay more attention to some key ratio rather than other ratio, or to some values, to some, indicators. And so you can end up with a totally different analysis than another value investor. Then you can consider all of them. There are no problems. You can consider the multiple valuation, the financial statements, and so on. Then, especially if you watch some videos, some interviews done to the value investor, you will understand that basically they try to not panic. They do not overreact because they know they have invested in very good company. And so basically you have just to keep calm, wait, and don't behave like Mr. Market. Mr. Market is a definition done by Benjamin Graham around the investor that basically overreact. So it's a kind of prototype of investor that basically overreacts. When there is something bad or some bad news, or all the people sell, he sells, losing money. If all the people basically buy because of the FOMO, fear of missing out, he buys as well at very high prices. So we have to behave in a different way. And then basically a diversified portfolio of a superstar company representing different industries, sectors of the economy. And then, of course, this method takes time. Takes time to analyze, to find companies, and especially require a certain kind of expertise, require also not only a certain amount of money, but you have to study, you have to learn, you have to read books, because it's not something, let's say, really easy to read basically a financial statement and to capture all the different nuances that you can spot. So for this reason, many people prefer to go via ETF. And it's a very nice way. I like ETF. I think it's a fantastic instrument. Of course, you can have less return than basically investing in some superstar company. And in general, it's true, it takes time. It takes time to find companies, but no one blocks you to, for instance, look at the portfolio of the great investors. There is a website called dataroma.com. You can find every 3 months there are the updates. And you can find what a super investor has bought, has sold, and then you can have some ideas from what the great investors do. So it's there are some people that they copy a strategy, or they copy partially a strategy. So it's totally fair. A quick recap. So we want to minimize the risk, and we want to minimize the risk, improve the gain with the long-term superstar companies. We want to find a superstar company with a durable competitive advantage. They could be more predictable and, let's say, a kind of a sure thing, okay? So if I can identify a trend over 10 years, I have a good chance that the company could basically do the same in the next years. Then the long-term competitive advantage means no lowering price to compete with other business. Because if you have a competitive advantage, you will not lower the price. This is for sure. Because people want to buy your product. You own a peace of mind of the consumer, of your customer. And basically, you don't have to compete with other companies in the same market. So you have higher profit margins. And we have to look at the financial statement to find indicators of the long-term competitive advantage. So I thank you very much. I hope that you arrive at the end of the video of this first episode. I appreciate a lot that you have arrived till here, that you have followed me, and really thanks again. I hope that you will press the like button and the subscribe so that you can receive updates of the video that I will publish. And here I leave you some references. So as finance resources, I'm using different books. So I'm reading and study different books. I use a lot Investopedia. I think it's a very great site with really valuable information. I like it a lot. And then I have some media resources that I've used for this presentation, so like Icon Monster and Unsplash.com. Thanks a lot, guys, and see you the next episode.